Every empire thinks its money is eternal. But money, like power, always fades. And history shows the downfall often begins with a single coin. Today, we travel back nearly 2,000 years to the streets of ancient Rome, where silver coins once ruled the world, and where the story of modern inflation truly begins. Long before paper bills and digital banking, Rome's entire economy was built on silver, the denarius. A small round coin stamped with the emperor's face, but that coin wasn't just money, it was trust. When a Roman soldier held a denarius, he knew it contained 4 grams of pure silver. He trusted that silver's weight, its gleam, its value. That trust powered an empire of trade, taxes, and conquest. But empires grow hungry. Wars cost money. Armies demand pay. And soon, Rome faced a question every nation still faces today. What happens when you want more money than you actually have? The answer was deception. Around the 2nd century AD, Rome began quietly reducing the silver content in its coins. Just a little copper mixed in. The coins looked the same, but were worth less. By the year 250 AD, the denarius contained less than 10% silver. It was mostly bronze, silver coated to fool the eye. But the markets noticed. Prices rose. Soldiers demanded more pay. Inflation had arrived, centuries before we even had a name for it. As the value of money collapsed, trust collapsed with it. People stopped accepting coins. Farmers refused to sell food. Trade slowed. In desperation, Emperor Diocletian issued one of the first price control laws, the Edict on Maximum Prices, in 301 AD. He tried to freeze prices by law. Traders hid goods. Black markets spread. You can't legislate trust once you've destroyed it. By the late 3rd century, the once mighty denarius was worthless. A single loaf of bread could cost thousands of coins. Citizens turned to barter, trading food and livestock instead of money. When a currency dies, people return to real things, just as investors today rush to gold, real estate, and Bitcoin. The collapse of Rome's money wasn't the cause of its fall, but it was a warning sign. The empire that once bought the world couldn't buy a loaf of bread. The pattern didn't end with Rome. Medieval kings clipped coins, shaving silver to mint new money. Spain flooded Europe with silver from the New World and caused the first global inflation. Then came paper money, revolutionary, convenient, dangerous. When governments printed too much, trust evaporated again. In France, in Germany, in Zimbabwe. Different eras, same mistake. In 1971, the United States ended the gold standard. For the first time, the dollar was backed by nothing, only trust in the government. Since then, the money supply has exploded. Prices rise slowly, then suddenly. Rome debased its coins. We print our dollars. It's the same process, faster, invisible, and digital. Inflation isn't just an economic force, it's psychological. When people expect money to lose value, they spend faster, buy harder, borrow more. That fear fuels the very inflation they're trying to escape. In Rome, citizens rushed to spend debased coins. Today, we rush to buy assets, before prices rise again. The empire doesn't need to fall for its money to rot. It just needs people to stop believing in it. So, what does Rome's silver coin teach us today? First, every currency is built on trust. Whether it's metal, paper, or digital, its power comes from belief. Second, debt always leads to temptation. When empires can print their way out of trouble, they always do. And third, inflation is not an accident. It's a policy, a quiet way to shift wealth, reduce debt, and maintain control. Rome used copper. We use keystrokes. But the story hasn't changed. Every time prices rise, we look for villains: oil, war, corporations. But behind it all lies a simpler truth. Money itself is fragile. When those in power forget restraint, the same cycle begins again. And in every fallen empire you can still hear the faint echo of coins clinking, the sound of a promise broken. The Roman denarius began as the most trusted money in the world. By the end, it was worthless. The lesson is eternal. Money dies when trust dies, and trust dies when power forgets restraint. So the next time you hear about inflation, don't just think about prices. Think about Rome. Think about coins that looked the same, but weren't, because history doesn't just repeat, it whispers warnings. If you found this story insightful, remember, every modern problem has an ancient echo. Subscribe to Financial Historian 2.0 for more hidden stories about how money, power, and history collide.